So we are seeing people kind of shore up their finances saying, look, I may not do a fully deferred exchange. I'll do a partially deferred one, pay the taxes on the boot that they get. But guess what? They're just paying that on the boot that they receive. They still get the benefit of a 1031.
One of the downsides with the Delaware statutory trust is the fact that typically there's a thing called the 7 deadly sins, where generally speaking, it's not a value add opportunity. Back in before the '08 crash, there was a lot of these ticks that came out that people did these fractional ownerships into. A lot of operators lost a lot of money, and a lot of people lost a lot there. And they've cleaned up a lot of that up. Where the Delaware's now typically it's not value add, which is not great either, because now I'm giving up, and I might diversify out of my multifamily property in Sacramento into like a Delaware statutory trust portfolio. However, they're kind of turnkey, right? I mean, they're beautiful properties in beautiful locations with first-class operators, tend to have huge fees, by the way. 10 to 15% of every dollar is getting knocked out. And so I go, what's the value of diversification? Definitely valuable, but also what's the value of liquidity? The one downside I see right now with the '08, what happened, and also right now what we're seeing is if you don't have liquidity and the ability to to be out of debt, because the 1031, one of the challenges too, Scott, let's be honest, is that it has to replace the debt, right? It's equal or greater value, which means equal or greater debt if you have debt on the asset. If you don't have debt, then that's different, right? And that can put you in a tough spot where if you have liquidity, diversification, the ability to go back into real estate at great timing or just diversify it, right? With operators that have value add opportunities versus just turnkey deals. Again, maybe I'm living in my own world here, Scott, but what am I missing if I could have all that?
A value add is certainly a better way to do that. But I will share with you something in the market. You mentioned correctly, what do you need to do for full deferral? Very simple. Reinvest all your net equity after closing costs, same or greater amount of debt. About 1/3 of our clients, Brett, do partially deferred exchanges. So they might replace the debt, but right now, because of the market, they might pull out 300-400 grand of equity, pay taxes on that. So they buy one replacement asset. They do a partially deferred exchange. It's called cash boot. They pay taxes on that. So we are seeing people kind of shore up their finances saying, look, I may not do a fully deferred exchange. I'll do a partially deferred one, pay the taxes on the boot that they get. But guess what? They're just paying that on the boot that they receive. They still get the benefit of a 1031. Now they've got a little bit of cash in their bank account to help weather challenges that are coming ahead. Because if you look at this, we all saw the yield curve invert. I think a lot of people think that there's still decent odds of a recession of some sort. Why not build up your balance sheet now, right? Take a little bit of money off the table, take a little tax hit, and then put that cash aside to kind of weather the storm and be in a little bit of better position there.